Another section that may be reported in the income statement is a discontinued operation, which is also a unusual item in the income statement. It is only reported when the company discontinued one component or some components of the business entity. If this happens, we will report this impact on both balance sheet and the income statement. And we will also change the name income before tax to income from continuing operation before income tax. So after we subtract income tax expense, this section above is income from continuing operation. Following this section, we will report the impact of discontinued operation on the earnings or income statements. Since we have subtracted the tax, so 750 was a number after tax. So when we report the impact of discontinued operation on earnings, we should also use the number after tax. So here, the impact is income from discontinued operation before tax was 200, while 50 tax expense. So the net impact will be 150. That's a plus. Then the sum of both will be the net income. So the numbers reported following the income from continued operation are reported net of tax. And we know the company won't discontinue their operation every year, right? So this only happens when the company has a strategic shift or change, which have a quite material impact on the company's operation and their financial positions. And this section reports two components. One is the income or losses from operation of these discontinued components or subsidiaries. So this regarding the financial performance of these discontinued segments, subsidiaries. This segment or subsidiaries is an asset. So when it is sold, the mother company may also recognize either gain and losses. So there's two components. Okay, so this example actually reports the combination of these two. So the accounting treatment for discontinued operation in the income statement depends on whether the components has been sold or disposed of, or it's just considered held for sale. Accounting treatment is a little bit different for these two scenarios. First, if the components has been sold, we are going to report the income losses from operations of these components that has been sold. Okay, so this section reports the financial performance of this division. This division is an asset to be sold or disposed of. Since the company has transferred the title of these assets to the buyer, so the gain and losses will be recognized. Depends on, the difference between book value and the fair value. In this case, the income losses, we use the beginning. So here we are given the information. This division was sold on December 18th. So we are also given the beginning. In the beginning, this division generate $5 million loss, pre-tax loss. Well, these assets, this division was sold for $15 million. Its book value was 12. So we have the information for both. So first, let's calculate the sum of these two. 5 million loss from operation, pre-tax. Subtract 3 million gains from sales of this division. So the difference is $2 million total loss from discontinuing this division. And while this is a pre-tax number, we should incorporate the impact of tax. Since it is a loss, it will generate 25% tax benefits. So the net of tax impact is 1.5 million. Finally, the company's net income was 18,500,000. So here, the $5 million loss was from the operation. Also, this number is borrowed from the beginning balance, while the gain losses depends on the actual price and the book value. If the division or segment is held for sale, it hasn't been sold, so accounting treatment will be a little bit different. First, the income or loss from operations of the component from the beginning of the reporting period to the end of the reporting period. So during this period, not just the beginning, okay? And also we will recognize only impaired loss. In other words, only when fair value is less than book value, we recognize impairment loss. We do not recognize gain if fair value is greater than book value. So that's the biggest difference from this example. So let's take a look at this example. So here, the division had not yet been sold. It is just held for sale. The company plans to sell this division. First, for this year, okay, operating loss pre-tax 5 million. And because the fair value or the price 9 million is less than the book value, the difference 3 million is an impairment loss. So impairment loss plus the operating loss 8 million. And net of the tax benefits 2 million, so $6 million after tax loss. And finally, the net income reduced by 6 from 20 to $14 million. I just assume the selling price is $15 million, just like the prior example. The $3 million difference will not be recognized as gains. Okay, because GAAP does not allow companies to reverse the impairment loss or recognize gains. Also, the discontinued operation will have impact on the balance sheet. This is the balance sheet just for the discontinued operation or divisions. And all the assets, liabilities will be removed from the book of the parent company. So here is a multiple choice question. We are given income before tax, which is a pre-tax number, and the 75 loss from discontinued operation. So these two numbers we can calculate because both are pre-tax numbers. So since this has included the loss, the income before continued operation before tax will be 775,000 plus 75,000. The question asks us the income before continuing operation, which implies this is after tax number. So we multiply 1 minus tax rate. So the answer is B. Here, the disposal of the division was expected to be concluded by March 30, 2025, the next year. So this is an example when components is held for sale. So we should use operating loss plus the impairment loss. So total will be 220 million. And so the after-tax impact, you just multiply 1 minus the applied tax rate. And since this question asks us before tax loss, so this is sum of operating loss and impairment loss. This question asks us the income from continued operation before income tax. So actually we should exclude this. Why? Because this is reported in the income from discontinued operation. Yeah, basically we just report all other items. So the income from continued operation includes all the rest items.